Have you ever wondered why the property market can soar to dizzy heights, only to plummet dramatically soon after? In today's video, we're diving into the rollercoaster world of property, exploring the thrilling peaks of market booms and the startling plunges of busts. Whether you're looking to buy, sell, or simply understand the market, this is a journey through the boom-bust cycle you won't want to miss. In the post-war period, UK house prices, even adjusted for inflation, soared by a staggering 600% since 1960. This monumental rise has had a profound economic and social impact, reinforcing the popular belief that you can't go wrong with housing. Yet, this wasn't always the norm. From 1850 to 1950, nominal house prices barely budged, and real house prices remained effectively flat. This raises a pivotal question. Was the post-war housing price boom an extraordinary anomaly, unlikely to reoccur? While we often concentrate on the immediate impacts of rising interest rates, it's crucial to consider the 4 or 5 long-term factors that may now be turning against the housing market. This video explores whether the decades-long surge in house prices is a relic of the past and what this means for young people desperate for affordable housing. Is the era of lucrative housing investments over? The explosion of real house prices wasn't confined in the UK, it was a global phenomenon. However, the UK experienced some of the most significant real price increases. This boom was driven by several factors, including a rapid increase in population during the post-war period, which spiked demand for urban living. Not only did the population grow, but societal shifts such as a decrease in household size, fewer children, and more single-person households meant that the demand for homes was increasing faster than the population itself. This increased demand led many countries to a tipping point where new housing couldn't be added quickly due to urban expansion limits reached in the 1950s through rail and car expansions. The ensuing shortage pushed prices upwards. Moreover, during the post-war period, rising population densities saw the emergence of a powerful NIMBY, not in my backyard, voting bloc, resistant to new housing developments, which was compounded by selective building practices in places like the UK, where there's been a hesitancy to construct high-rise buildings often associated with low-quality social housing. Many of the tower blocks built in the 1960s have already been demolished. However, these long-term drivers of house price increases may be reversing. This is even before considering the impact of the recent shock of higher interest rates, which have contributed to a 14% fall in real house prices in the last few years. The outlook for housing could look markedly different over the next 50 years. Demographic factors do play a significant role in housing prices, and the significant population growth of the post-war period was a key factor. Yet, this trend is expected to reverse soon, as fertility rates are falling globally, particularly in Europe, potentially leading to a dramatic drop in house prices due to a surplus of housing relative to the population. While the UK remains somewhat of an exception due to high migration, maintaining population growth until 2050, recent data suggests that fertility rates may decline faster than previously predicted, possibly along with migration levels. Furthermore, the post-war period's rapid decline in household size is beginning to reverse. For the first time, we're seeing a slight increase in average household size, often due to children living with their parents longer because of unaffordable housing. This could be considered a direct result of the housing crisis itself. More critically, the gross housing rental yield has declined over the past decade, and research indicates that the long-term yield from housing has decreased even more sharply. When short-term interest rates are substantially higher than the return from housing, demand weakens, given the prospect of limited or negative capital gains. Last year was disappointing for those hoping for a rapid revaluation of house prices. Higher interest rates have reduced affordability and increased the proportion of income that first-time buyers must devote to mortgage payments, often cited as a major barrier to home ownership. Now, you might wonder if the historical growth will continue to support the housing market, particularly through wealthy investors and large institutional players. However, with long-term interest rates on government bonds rising from 1% to 4%, investors now have more attractive investment opportunities than property, which offers lower liquidity and higher inconvenience. Will wealthy parents aid their children in entering the housing market? To some extent, yes, and this is a significant aspect of the UK housing market. However, parental wealth alone cannot sustain a long-term boom in house prices. If house prices stagnate, so will housing wealth, and not everyone can rely on family support to purchase a home. The mortgage market, already stretched to its limits, along with the post-2008 financial crisis, changes in lending practices, suggests that the era of easy credit that fueled the housing price boom may be over. Although there's unlikely to be a crash in prices soon, nor a quick bounce back, this would require sustained real income growth, another long-term factor that might not return to post-war levels. Additionally, the end of NIMBYism and a shift in political focus towards more housing development could change the landscape. I hope you've enjoyed this video. If you have, please remember to like, comment and subscribe. Let's continue the conversation. And as always, I'll see you on the next one.